Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Welcome everybody to our episode 29 of our Multifamily 0 to 1. And I see a few people that may be here for the first time, so thanks for joining us. And again, our goal here is how can you get started in multifamily, how to go from 0 to 1, or if already got started, how can you get better at multifamily investing? And on tonight's episode, we focus on how to get started or better as a passive investor. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. So some of our introductions. So my name is Marcelo Cazini. I'm in Houston, Texas. My background is in IT and software development and project management. And I'm a local CCIM member with all the required CCIM designation trainings. I'm a multifamily investor. I operate my own commercial real estate. And before multifamily, I've also done single family fix and flips, but now I'm 100% dedicated in multifamily in the real estate space.
Hi everybody, this is Claudia Rubio. My background is in asset management mostly, although I am an architect, but I've been managing my own assets since I was 19 years old back in Colombia where I was born. And now we're doing syndication with Martin here in Houston. He will tell you a little bit more about it, but we've been here in Houston for 8 years.
And I'm an IT security consultant. I've been doing this for over 25 years. So I have more of a business management background to complement Claudia's experience. And we use that to start syndication. And so far we've been doing it for 2.5 years. And it's been a great experience that we hope everyone gets to either taste from the investor side or from the syndicator side successfully.
All right, thanks, Martin. Sharon, welcome. Would you like to introduce yourself?
Sure. Well, I started out in single family as well. So I self-managed about 12 single family homes at one point in time. I do currently have about 10 apartments in our passive portfolio. I had previously had 12 in total. 2 did go full cycle. So they sold, and I love the property in Duncanville, Texas that did have a 200% return in 30 months. It was really, really awesome. Yeah. So I work with my partner, who is also my husband. And my background initially, I do have an MBA from the University of Dallas in Irving. And I have been able to leverage those crossover skills for multifamily. It's kind of learning a new language if you're really looking at numbers. And that's what I've been doing. I spent 5 years doing that after the 15 years that I spent in single family self-managing. So in 2015, I became a student of Brad Sumrock, who is my mentor for that. For single family, I did have a mentor with Alan Cowgill. He did help me cross over into working with private lenders. So syndication was not really a foreign thing for me to work with sponsors and in a syndication environment, a collection of investors. So that's what I've got, about 15 years in investing, 5 of which are specifically in multifamily, and that's kind of where my focus is. I'm really kind of trying to target that and focus it so that working with those better returns, to be quite honest, and more tenants under one roof and working with a third-party management company versus, somebody calling me in Colorado with, something that's broken in a single-family home.
Right.
Yep, that's awesome.
Because I was really more of a buy and hold kind of person. So I manage what we bought. So
I
Makes sense.
love what you just said about learning the language of numbers.
yeah, it is. It's just
Yeah.
learning the language of a different set of numbers.
That's true. That's true. And I'm sure you're going to talk a little bit more about it, but I wanted to ask you, why multifamily, and what is the most attractive thing about multifamily for you?
Well, the most attractive thing about multifamily for me are really those returns. Those returns are really significant. And also working with third-party management versus me having to use all those different hats and being the only person that anybody calls. I mean, I had a team that I worked with. I had handymen, I had contractors, I had a real estate attorney. I had a whole team that I had built just around the single family portion of the business and in the first company. But it is very attractive to have a third-party management company. And through the passive investments, I've got to learn, I have been able to learn several different management companies, who they are, what they do, what are they specializing in, and that's part of my analysis. What third-party management company is going to be the property managing company.
Right.
Yeah.
So there's a lot of people coming into multifamily who have never had any experience on real estate at all, and there's people that had a lot of real estate single family experience. I know people who had 30 single families when they found multifamily. The common denominator between all of these people is they talk about education, and we try to focus a lot on that on these meetup. So when you found out about multifamily and you decided, okay, this is an avenue I want to pursue and I want to get educated on this, how did you start? Did you go straight for a mentorship? Did you research on books or the internet or anything like that?
Well, I did seek out another mentor because I'd had a mentor for single family. I'd had a mentor who specifically worked with Dan and I regarding private lending. We went to a boot camp, learned how to do that. So we were not reliant on the banks in the 2008-2009 time period because, frankly, banks weren't lending money. So you had to figure out how to do some creative financing. And so I actually had a mentor in the DFW area that brought in Brad Sumrock. And so I got to go to Brad's R2R for free. So it's the only time that's ever happened. So, and then we went to the first R2R, and Dan and I were convinced that this is a system that we could work with and work in. And to really repeat success, you have to use a system, achieving your goals. You can get to that with a one-time process, but to really have success after success, you really do have to have the system. And I believe I had to have a mentor to reach continued repeatable success.
Yeah, makes a lot of sense. So you found this mentorship, you went through the materials, the trainings, met people. When did you feel ready to jump into your first investment? Like how long did it take you? What made you think, okay, I think I'm ready? What's that flag to jump in the water?
Well, really it was 2 weeks because at that point in time, I'd had 10 years experience, single family. We were working with private lenders. We were recruiting our own private lenders. And just the entire team that I was working with on the single family side. So, we had a person who had a deal at that point in time, and we felt comfortable with that. This person was in the aerospace industry. Dan is in aerospace. He works for Bell Helicopter. So we felt like we could really jump in while we were still concurrently going through all of the material as far as, the modules.
So for that first deal, your most important variable was knowing and trusting the sponsor more than a specific market or a specific return or something like that?
Well, I really value trusting sponsors highly. I will tell you though, Martin, that one of the things that if I was doing it all over again, I wouldn't have invested in that particular market.
Okay.
It was this, that particular market, as Oklahoma City, I'll just say it, was, there were SUMROC students going into that market, but they were the first into the market. And so then you had, before you had COVID-19, you had really kind of a downturn in oil and very energy dependent. Oklahoma, many Oklahoma cities are, even some of those who have major universities. So, and that's a situation with Oklahoma. So.
Okay, makes a lot of sense. I think a lot of people got bitten by those new markets out there. We were one of those too.
Yeah. But that property has sold, and it came out well, and that particular sponsor, because he's just really keeping his eye on the numbers, got it to a good place so the sale could occur. And another one of the investors hooked that sponsor up with a broker who could successfully lead to a sale, a strong sale. So it's kind of a little bit of a team effort, between the sponsor and some of the investors on that particular property.
Okay. Yeah.
So what are some of the characteristics of that first deal you mentioned it was Oklahoma, but like how many sponsors do you remember? How many units? Can you tell us a little bit more about that first deal?
It was 144 unit property. There was one sponsor. So it was a single sponsor. It wasn't a team. And it was C-class. And if I had to do all over again, I would have probably done what I've done so many times on single family, do the drive-by. I didn't, on that particular property, I didn't do the drive-by. And me being up here in Denton, Texas, I was within range to do that. It was just a 3-hour drive. Those are some of the things I would have done differently from that particular first investment standpoint.
Yeah, I think that's a great tip. Like usually they, when you start learning about multifamily, many people say, hey, you can invest anywhere remotely. And up to a point you can, but you need to be really good at the other stuff, right? You need to be able to underwrite, do the comps and everything else remotely. If you're starting out, then it might be a good idea to go drive there. And same thing.
Well, there's just some things that I would have picked up. I would have picked up how it was sandwiched in kind of a little more commercial area. There's just things that I would have immediately picked up because it was some of the same skill set that I'd used in single family acquisitions, to be quite honest.
Mm-hmm.
Yeah, so often we see when we're analyzing deals, we see markets that they change street by street. So if you don't actually get to look at it, you may think that, oh, this neighborhood is good, but you don't realize that, oh, now maybe you cross the freeway and all of a sudden it's a whole different neighborhood altogether, even though it's very close. So
yeah, Houston's like that.
Yeah, for sure.
A lot like that. Yeah.
And for someone, like we do get a lot of people in our group that they are looking to do their first investment or their next investment. If they have never invested in multifamily, given all your experience now, Sharon, in all your 12 deals, what would be your best advice for somebody who they're starting right now, given where we are on the market with COVID and everything?
Yeah. Well, I would really ask a lot of questions of the sponsor or the sponsorship team. I would really find out what their history has been before COVID, and if they had properties that they were managing during COVID, how was that working? Really, how was that working for them? And I would really decide myself, what markets am I going to invest in? Because that's one of the strategies that I'm changing. There's certain markets that I'm investing in, and there's certain markets that are just not going to be part of that passive investment portfolio in the future, or at least for a while. Mm-hmm. And I want to be in those markets where there's growth, and part of that migration path or pattern, as well as a pattern of wealth. So it's kind of like, where's there going to be an uptick in population, and what's that population going to be looking like? You've got some individuals coming from the West, and you've got some coming from the East and some coming from the midsection, and it's kind of like, okay, where's the wealth pattern, but also where is the workforce pattern? I mean, where are individuals who are needed for different skill sets? Where are they moving from? And kind of tying that all together.
Mm-hmm.
Makes sense. So ask a lot of questions to the sponsors before and during COVID, their experience, and also you would be more specific about the market, focus on population migration and wealth. That would be some of the things you'd suggest. That's very good points. Now, especially, I think now we're starting to see a pickup on deals again that, they were dormant for several months last year, but I think anybody that's on a lot of investor lists, they're probably starting to see more options now to invest again. Do you have any, if you're getting a lot of leads from opportunities from different investors, do you have any techniques that you go through to, okay, this deal I'm going to look further, this deal I'm not going to even look at it? How do you go by analyzing deals that are presented to you if you're maybe getting too many of them?
Yeah, I get a lot in my email box, and I know you all do too, all the time. And it seems like the more people you're in contact with, the more people they're going to send you an email. They're just going to, they're dialing for dollars. Sometimes it's through their email box, sometimes they're going to give you a call. But first, is it a city that I want to invest in right now? Is it a state I want to invest in right now? And then also, what's the age as far as the year built? I'm not going to be wanting to invest in a 1964 apartment. And I've had a couple of those in my inbox just this week, but that's not a year I want to start with. I'm going to start with mid 70s moving forward. I don't want to deal with boilers and chillers. I don't want to. I don't want to deal with that, because that's more expense, And then I've actually spoken to a couple of my sponsors who actually do seem to know kind of histories of some properties, and they even know, who were some substandard builders on some properties. And it's kind of like, okay, wow. They just seem to know all this stuff and know all these different people. And it's got to the point where that's one of the first people I call. I want to see, what is the history? It's kind of like, what's the dirt on this property? What's, what hadn't been managed well? How, was it, not built all that well? And has there been a problem with vacancies? With raising the rent? What's up with it?
Do you actually get to underwrite the deals yourself and compare what they're doing, or you just trust the underwriting from the sponsors at this point?
At this point, I don't. I may in the future, because Dean and I do run some analysis on some properties that we're considering making an offer on, and I've just gone through properties that the numbers just don't add up because I'm in contact with brokers too. So I have a relationship with some brokers that I've been talking to about being part of a sponsorship team but there's just certain areas of Irving that I'm not going to be acquiring an apartment in. And I am a passive investor on a 354 unit that's actually in Irving and has a really awesome tenant base. It's really, you and Martin will love this. It's a significant population in that apartment are IT people. So so they can pay the rent, and it kind of bumps up the demographics in that little quadrant, and it's really awesome.
That's cool.
Good. Do you when you are analyzing a deal, when you're presented with a deal, do you look at what the sponsors are doing in terms of expenses, reducing expenses, increasing revenue, and those kind of things?
I do, and I look for anomalies. I look to see if something isn't quite right, because I did spend years as an analyst before real estate investing. So I had a lot of graduate hours in accounting and finance, and I built budgets, for corporations, and did some budgeting for some not-profit organizations. So, I can kind of tell if something, it's kind of a number sense. You can kind of see if something just seems kind of out of line, and then you ask about it, and not just something that's a seasonal increase, because we all kind of know about that. In certain areas, you're going to have to spend more on exterior work, like the two properties that I have up in Columbus, Ohio, and one that's in Aurora, Colorado. There's only a certain time of year where you're going to be able to do exterior work. And so those expenses, they're going to be increased, but it's because of the compressed time period where that work can be done. But it's not like the property expenses way out of line. And I've heard of stories that a sponsor did go on a vacation, and just the property tax just wasn't protested, and so you just don't want to see stuff like that.
What about income or other income?
Well, there's certain thresholds that I want to see, and a certain expectation that you want to see, above and below the line. So you want to see a certain expectation for the occupancy, because it drives so much. You won't get to the income level if you don't have a significant tenant base that is going to be paying the rent. I really love my the occupancy in my passive investments to be like in the 90s. That's just, I just want more money coming in. So I want less evictions, because it's, more expenses going out. Not only on the rent side, but then you've got to send somebody to JP court and stuff like that. So it's there's certain areas, there's just certain things I just kind of like to go kind of down the spreadsheet, down the income statement, down the balance sheet. So just see what's working and what isn't. Do we have enough NOI? And and I don't want to be in any danger of there will be a capital call, or that the sponsor is really underestimated that CapEx budget. I definitely, that I don't definitely want that.
Have you had in any of those any capital calls?
I have not in my portfolio. I have heard of some, and the investors I know that have been part of that, they haven't been in their happy zone, for sure. But I have not had that in my portfolio.
Good.
But then again, I call my sponsors. The numbers aren't looking, what I want them to be looking like, or that the first thing I'll ask about is occupancy percentage.
Mm-hmm.
And they know to expect a call from me if it's, if it's not, in the high 80s and in the 90s, because the 90s is my happy place.
Yeah.
Mid 90s or upper 90s is my really happy zone.
Yeah.
But I'm a very exacting passive investor. I'm a not so silent passive investor.
That's good. That's good.
Yeah. Yeah. So I wanted to ask you, with the experience you have today, what would you have done different?
Well, as I said before, I would have driven that first property, but also tighten up on those cities and those zones first, because it's kind of like get to the place quicker than I'm at now. As far as there's places I want to invest in, and I know I want to invest in them. It's just a matter of finding the sponsor or the sponsorship team that is there and that has a local component. Not everybody is out of town investors. That's one thing. Arriving at that point sooner is always a good thing. And if I only had more and more money, it's just kind of like, that's always the thing. You're like, wow, I would like to be able to do, like 3 of these, but I only have, so much at this point in time, because I still have money tied up in apartments that have not sold. If I could get them on a schedule, that the sales don't happen on a schedule all the time. And I have some investors. I have some investors that you thought it might be a 5-year, and it's a more like a 7-year kind of hold horizon. And you just can't put it on a little spreadsheet and say, oh, this is going to be sold by this time, and so I'm going to have to free up this money, and it's going to be double at least, or so there's a certain amount of uncertainty, which I like to reduce that as much as possible.
So Rasul is asking, when you said that you had an expectation for income, so he's asking, is that mostly the 90+% occupancy, and you're a happy camper, or is there something else that you really look deep into?
Well, I really like those distributions to go off like clockwork. Not all of us do. So I like my cake, and I like to eat it too, because I like my distributions. And then at the back end, for the sale, I like the sale to not just be at 100%, but go beyond that. So, and if that happens during a time period that's less than 5 years, that's really awesome.
Mm-hmm.
So that just means you get that money sooner, and it's the velocity of money concept. You can just reinvest, and you just grow your portfolio and grow the fair market values within the portfolios, because Dean and we just did the calculations on those, because we're getting those K1s in. So Yeah, I have actually more than one metric. It's not just the obsession with the 90% on the vacancy, because I do like to go in the portals if certain sponsors have portals and see that, yep, got that distribution and this is what it is, and it's looking good, it's on target, and then and then those monthly operational reports. So I like to see those, and then see how we're doing at the back end as we click along, because I have just about 2 properties since 2015. So I have 2, each year. So I'm having discussions with each sponsor. It's like, well, when are we going to be selling? What's the exit strategy look like right now? So I'm always asking those kinds of questions. Where are we? Where do we look like that's going to sell? What's that going to look like? And I just, not all my sponsors want to, talk to me about that. But most of them do. Most of them do that are really have really got their noses to the grindstone on it. And those are the ones that are repeat business. I'm kind of more addicted to working with them, because I know what to expect, and I don't like uncertainty.
Yeah. Are you doing multifamily or real estate in general full time?
Yes, I am.
That's awesome. Yeah.
I've been doing that the whole time. So I am the real estate professional within the Riddle partnership.
So you're also taking a lot of tax advantages there. That's good.
Yes, I am, and I love that too. Yes, we're working with. I have a bookkeeper. So because we have 4 companies, and also have a professional within Tom Wheelwright's organization. And so working with the team, and I will be asking for tax strategy every time we're talking to them. How are we going to minimize the taxes? So, yeah. I ask those questions too.
Okay.
Yeah, we have another question. When you started from Jing Chai, when you started out, number one, it's divided into number 1, did you focus more on capital growth versus cash flow? And the second one is, how do you balance having some liquidity versus putting it all into investments? So growth versus cash flow.
Okay. Well, I really kind of like to do both, because I really like those distributions. So I like the cash flow, but I look at each separately, to be quite honest, because we have the operational reports, tracking all of that information through the bookkeeper, because we've got everything set up now for chart of accounts for different companies, so we can kind of roll that out and see what that's looking like. And then also how are we doing as far as the appreciation? So with the properties, we look at the fair market value, and we get our K1. So we have to kind of, with a couple of these companies, Dan has those housed within a custodian. So it's self-directed IRA, one is a QRP. And that way we can kind of see, what's the valuation? How are they appreciating? Because then that really rolls down into my personal financial statement, which is, of course, my net income, my net worth. So I like to have tools to analyze different segments of cash flow, but also of the capital or the appreciation.
Yeah. So
I hope that answers what they're asking.
Yeah, and a lot of they want to know also about, how do you balance having liquidity versus you putting everything in investments? Like how do you make that decision? How much do you keep?
Yeah, I kind of have to have a certain amount, and right now I've got about 130,000 out there. So I don't just throw everything in, because to be quite honest, there's always going to be a deal popping up. So you won't, every deal that you see that you're just like a kid in a candy store, you won't be able to invest in everything. You just, and I know that as an investor, sometimes I feel like, oh no, I'm going to be left behind. You get the left behind. Oh no, this could be like the greatest investment, ever. And I'm not going to be on that. And, I'll be sad. And other investors will talk to me and they'll be part of that. But, you just got to fight that off. I mean, you got to fight off that feeling, because it's never, ever going to go away. But yeah, I do keep a certain amount. And right now, that amount is probably 130,000.
Okay, thank you.
Yeah, and I think an important point about the focus on the capital growth versus cash flow, we do see that properties that have a bigger emphasis on capital growth, that they're riskier investments. So typically, if you want to diversify, you want to make sure that a big portion of your money comes back as cash flow, versus just having everything at the tail end, because then if anything happens with the market at that point, then you are subject to variances in exit cap rates and interest rates. And so if you like his riskier investment, then yeah, you can go for more of upside in the capital growth. But if you want to make sure that you're not going for that risky of an investment, then I think we see a bigger recommendation of having a good portion of it coming back as cash flow.
Yeah. Most of mine really do fit what I would term a hybrid model. So I get both of that.
And one question that we got here too is, have you seen more often cash flow being distributed as return on investment or return off investment on the first few years?
So how do they define return on investment versus return off investment?
So some properties, and this is on the operating agreement. They say that what you're getting on the first few years, you're actually returning your own investment, so that's returning off investment.
Yeah.
So then that's not a taxable event.
Yeah.
In some properties, they are returning on your investment, so then that would be a taxable event. So have you seen, are your properties following one model versus the other?
I haven't seen as much of the latter, but then a couple of the companies that we do have are self-directed IRAs, and one of them we did convert to a QRP. So we don't really have as much of that until we draw any funds out of that particular self-directed IRA that is an LLC. I have one LLC that actually is it's standalone, so it's not a self-directed IRA or a QRP. So I would see more of that in that, but I'll be able to tell you more about that sometime this year, because I should have one, if not two, properties within my standalone LLC sell this year. So we'll see what the impact is regarding that. But most of the time we do try to manage that. But no, I haven't really seen that as much to date, but we'll see moving in the future. Yeah.
Okay, fair enough. And now on the current state of the market that we are with, the hopefully tail end of COVID situation, but are you doing anything differently now as you look for properties to invest? given what happened with the properties during the COVID timeframe, or are you still going through the same process that you were before COVID?
Well, I am tweaking that some. I mean, I still like my strategy of migration patterns, and I am taking a look and see how certain cities and states are recovering. So, say, for example, Ohio. I would only invest in Columbus, Ohio. It's the capital. It doesn't operate the same way the rest of the state is. You have Ohio State there, and you have nationwide. You've got some really big employers. You've got some really, so if I'm going to look at a state that's been kind of hard hit with COVID, or the recovery is kind of sluggish, it's going to have to be in a city that has more economic drivers than most of the state per se. But in Texas, I'll eventually have some investment in Houston. I did grow up in Houston as a young child, so and so I remember Houston. Still have relatives in Houston, but there's just a lot that's going on in Houston, and there's some migration pattern coming, and it's coming down into Houston too. I mean, it's part of that triangle. Part of it's Dallas, Fort Worth, but Houston is a significant player in that, and it's a sprawling city. It's a large city. There's so much. I mean, there's so many economic drivers, not just energy, for Houston. So Houston is definitely, on my target map. But I would take a look at that and see how the performance has been, and has there been a sluggish, recovery, and what the market is like as it recovers from the COVID-19 pandemic. So, and not all cities are going to recover as strongly as some others. So.
Yeah, makes sense. Now, Marcel was asking, on your mind, what is a good return, rate of return that you expect on a monthly cash flow basis, and what is the IRR on the back end that you typically expect once a deal has gone full cycle?
Well, I haven't really focused as much on the IRR, to be quite honest, and the return. Most of what I've seen has been greater than 8%. So that's kind of been my experience to date. That may change. I may ratchet that up, and I may really target a number more firmly. But my returns have been so strong that I haven't had to target it as much. And I think moving forward, I will have to target it more, because I was spoiled before 2018. I was spoiled with some of my investments and what the performance turned out to be.
Now, and how about total return? Do you have a number that you're typically targeting right now, or you're only looking at the monthly cash flow?
At this point in time, I'm looking more at the monthly cash flow, and I'm looking to see how that's. And I am really also looking to see what the back end sale is going to look like. So when they get to a point where they are willing, or they want to put a property on the market, I'll ask, well, what's that looking like? Because they'll always have some conversation. They'll always have some idea. Because the property that I have in El Paso, Texas, it looks like it's going to be a strong sell. And it really didn't, the monthly cash flow was not per the forecast. So, but I am continuing to tweak my metrics on some of these items. That's always a work in process.
And talk about returns again. I mean, how important it is for you preferred returns versus deals that don't have any preps?
Well, at this point in time, I still like my preferred returns.
Mhm.
I still,
So if you have, yeah, so all things being equal, if you have a deal that has preferred returns versus one that doesn't, you're gonna favor the one with preferred returns?
I am at this point in time still. Now, something could change my mind. Probably if, if I had a strong enough collection of investments that were already preferred returns, and then I could take on the other, that was kind of more a value add exclusively versus a hybrid. I might, change some of that up, but it would depend on, what my tax position would be too. So.
All right. Do you have any books or podcasts or systems that you would recommend for somebody starting out as a passive investor now?
Yeah. Well, I was going through my book collection, just kind of see what would be a good starting point. And many people know Robert Kiyosaki. I like Unfair Advantage. I like that particular book of Robert Kiyosaki. If you're at a beginning point, it isn't just a narrative of the rich dad story. It's actually got part of Robert's team that interjects in that as far as their specialty. And, and then of course he kind of, blasts the American school system, and he does a little bit of that, but he's got part of that he needs to kind of get off of his chest. But it is something too that you can read with some of your kids. Some of your kids can read it, like if they're middle school or high school, they can read that too. But I think Unfair Advantage is a good book to start with. And of course, I think meetups like the one you have right here is really excellent. I've been in meetups before, and a lot more meetups that were networking like in person versus virtual. And I was going to say that for some of the women that are in the group, not just all the men, I have joined a multifamily women's mastermind, and I get a lot of information out of that, a lot of support. But they also do have a book club, so they're sharing what they're learning, and they kind of are starting to have their favorite books. I didn't have the time to be part of the book club per se, but the book club is going to be spitting out wisdom that they have gained and the knowledge that they've gained in various books in that particular Facebook group. So I'll be able to have even more books on my future book list to read through.
That's awesome.
Yeah, they're great. And I really like the format that you have of this particular meetup. So I will be tuning into this meetup certainly in the future.
Awesome, thank you.
Yeah, now that I've found you all.
I want to go back to the reports, the monthly reports you get from your sponsors.
Yes.
What do you like to see in the reports?
Well, as I said before, I really like my occupancy high, and I like the expenses lower. So, I like less vacancy. I mean, I know that if it's a particular hybrid, then there's a particular schedule, a CapEx schedule, so you're going to have a certain amount of vacancies because you want to turn some upgraded units per the CapEx budget. But I like those really on more of a time schedule where they're not just having to do a rehab that's a standard unit because they need to turn it. I like to see where they're upgrading per schedule, that which means that they were not having unexpected vacancies. So I like everything to be plain, and I like it where the tenants decide that they're going to renew, but they're going to renew in an upgraded unit versus a standard one that they had previously. So you've already got the history where you have a person that's paying, they're committed to paying, but they decide, hey, you know, I think I want upgrade. I think I want a few more amenities. So they're paying more for what they're getting. So those are my favorite.
Okay. Yeah.
What's the coolest and the worst stories that you can remember from those reports as a passive investor that you read?
Oh, well, from when the occupancy is like dipping, it makes me nervous, and I call those investors, you know, and I call the sponsors, and they have you know, they have a story about well, you know, the CapEx budget, you know, they're not having some draw release from a lender, and that you know, those kind of conversations make me queasy. It's like, well, when's that going to happen? And, you know, well, who are you going to bring in to kind of put the thumb down a little bit and make that happen? I mean, who are you bringing in? Because, you know, you got to call in more people to make that happen than what you're doing, obviously, because you're doing the same thing over and over again. That's insanity. You know, it's got to be elevated. And you have to have a team of people who are, you know, pushing that point so that money is released.
Yeah, we've
So there's some queasy stuff I've had in monthly reports that I pick up the phone call. I don't say, well, oh, that's sad that's happening. No. I got to call somebody, figure out what they're doing different.
right.
Shake the money tree.
Right. Yeah. Yeah. I've heard sponsors that complain a lot about that, about the bank is delaying a lot the draws. It hasn't been our case. It is.
Yeah, I think it depends a lot on the lender and the type of loan. We've had good luck, and ours have been very responsive, knock on wood. But yeah, we've heard some horror stories on draws being delayed for months. Yeah.
I've only had one that's been working out that way.
Okay.
And it's not in a Texas market.
Okay.
And we have I think one of our final questions here from Jane. Do you, when you're investing in your properties as a limited partner, are you typically investing on your own name as an LLC or as a trust?
An LLC. And we've used one of the three LLCs to do that. So it's always been one of the LLCs.
All right, perfect. All right, I just want to share some information here to everybody. So we do have a YouTube channel. So I'm posting the link on the chat here. So if you guys can also see the link on multifamily021.com. So if you miss a meeting, we have had some great sponsors and great passive investors over the past. We've been doing this for over a year now. So if you want to see some past meetings, please visit our YouTube channel, and then if you subscribe, you always get notified once we post new recordings there. And we also, I want to mention that we meet on the first and third Wednesday of every month. So our goal the first Wednesday is to start as a syndicator. So our next one is going to be April 7th. And then the third Wednesday is April 21st. And on the third Wednesday, we focused on getting started as a passive investor. So I hope to see you guys there again. And I do want to thank Sharon for spending some time with us and bringing your insights as a passive investor. I think even for folks who want to be a sponsor, I think it's always great to understand what's important for a passive investor. And so we always appreciate this meeting. So thank you so much, Sharon.
Thank you for having me.
Thank you, Sharon. It's been a pleasure to have you. We've been chasing you for a while. So
Yes, you have. You've been very, very persistent, Claudia, and I'm grateful for your patience.
Thank you.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.